Morning, Carl Peter.
Morning, Stephen. Another grey, cold winter morning in Cape Town.
Yeah, I can feel the cold in my runny nose.
Yeah, same here.
Great. So, Carl Peter, episode 6 today of Giving Wealth Purpose. The question is around offshore investing, and I think it's quite a topical conversation. It's ongoing. You spent most of your career working with sort of cross-border capital in the likes of London, Hong Kong, and the Channel Islands. So this is, from an investment point of view, this is probably your food.
Yeah, exactly. I mean, I have spent a big part of my career working in that offshore space, both locally helping clients invest offshore, but kind of working in kind of key global financial centers, like you say, between London and the Channel Islands and Hong Kong and, one or two other places over various stints. And I guess something that I learned watching people money move capital across borders, across jurisdictions around the world, is that the decision is never really about the money. When as South Africans, we ask the question, should you take money offshore? It often gives very conflicted and emotive points of view, depending on your possible viewpoint around, are you being disloyal as a South African moving money offshore? Or, things in South Africa are going to pot and, you should be taking as much money offshore as possible. And actually the answer, as we know, is a lot more nuanced than that, and really depends on, every individual and family and their kind of needs and circumstances. So I guess that emotive outcome, whether you should or shouldn't, both of them are largely driven by, feelings and emotions. But neither of them essentially is giving you a plan. And that's what we always come back to. What's the plan? What's the fundamental strategy? Because should I take money offshore isn't really, like we say, just about one question. And I guess it's a stand-in for a harder set of questions that many of us would rather not live with. So, what am I actually afraid of? Where is my life heading in terms of direction of travel? What currency will a lot of my future expenditure be based in? And we know this year the rules have changed as well. So your discretionary allowance has doubled from 1 million to 2 million. So moving money offshore has never been easier. You've still got the 10 million annual investment allowance that you can get approval for. So in terms of the mechanics of moving money offshore, is as simple as it's ever been. But it can also make it more tempting to move money offshore, I guess, for some of the wrong reasons. So today we're not going to tell you about whether you should or shouldn't be going offshore. We're going to try and help you ask the right set of questions so you can ultimately make an informed decision.
Yeah, that's great. I mean, maybe we should just take a step back and you spoke about that sort of fear or loyalty point of view. Maybe let's start there. I can remember back, I was an older sister, 10 years older than me. So when she was 18, I'm thinking probably like late 80s, kind of the first idea that I had of people taking money offshore. They were taking the so-called grey money. I know there were wealthy South Africans at that time were literally, sending suitcases or travelers' checks with people to go over to London to kind of put money in bank accounts. That was obviously a fear in terms of where the state of our country was at that time. But, looking back in my career as a South African financial planner, I think a lot of those conversations have been heightened when it's come to other political, let's call it instabilities. The Zuma era, and it comes to mind, when we had our finance minister Des Van Rooyen, the sort of weekend special, around that time, around the Guptas, I think there was quite a hot topic of conversation about South Africa, sort of doomsday profiting around South Africa and people wanting to move offshore. Quite often, look back now, at the worst times when an event has happened or something, has been publicized in the media and the media are running with it, the rand falling out and suddenly the appetite for taking money offshore increases. Yeah, that sort of talks to that emotional side of things. And, I understand that. And I think that also talks back to one of our earlier episodes around, following, the facts and, what's important, what are media selling us and what are hard truths. I think today what we want to look at is just unpacking what those important areas are. It should be a planning-led conversation,
No, exactly that. And I think, when it comes to, investing offshore properly as a South African, I mean, if I go back, to the early 2010s when I was still working for a British institution, helping South Africans invest money offshore, the concept for a lot of people was still quite foreign. And, is this legal and can this be done? And all the rest of it. And it's only really over the last decade or so that it's become, a lot more mainstream, acceptable. And the opportunity set now as a South African to invest offshore, particularly over the last 5 years with proliferation of the kinds of investments you can access and the funds available, etc., has made it a lot easier now. And it's obviously become a lot more topical. But exactly that, in terms of, when you think about building portfolios for clients, and how those should be structured. It's never about, should I be onshore versus offshore versus, based on, the news of today. It really has to be planning led. What's the future? What are the risks? Where are the opportunities? What are you trying to achieve in terms of your planning? And then it becomes a natural piece of the conversation. And that's how we kind of like to approach the discussion around offshore investing, for our clients.
Mm-hmm. So not doomsday-led, fear-led, but, more a planning-led conversation.
Exactly. So, I mean, Stephen, when it comes to then the conversation around investing offshore and whether it makes sense or not, I mean, what are kind of some of those key decision-making drivers and the kinds of things investors and some of our clients should be thinking about?
Well, Peter, we always an outcomes-based business, so it's kind of like understanding the purpose and then matching the strategy to kind of meet that purpose. And so, one sort of thing that comes to mind is kind of like, I guess, matching liabilities, There are examples of, families that want to create an opportunity for children to be educated abroad. And so taking money offshore to be able to fund that liability kind of makes sense. We have an increasing amount of families that have sort of, I won't say global citizens, but you kind of find children or grandchildren kind of moving abroad. And so, they might be trying to create provision for, property purchases. But that's the type of sort of thing I'm talking about around, matching that liability. And then, I guess if we look at the South African market, investment universe, I mean, we're not totally excluded from an offshore conversation. Most of our top 40 shares on the JSE earn their income offshore. Especially, if you're looking from a rand hedge point of view in the mining counters, we do have that rand hedging. And even our normal local South African investments in our pension funds, those type of balance funds have a direct offshore component. So we're not totally excluded from offshore if we're just investing in South Africa, are we?
No, exactly that. So, I mean, I think every South African investor today, by and large, is going to have a fair degree of offshore exposure in their portfolio through, like you say, their retirement funds, which will have that offshore allocation built in through those rand hedges that are listed on the JSE. But I think something that we kind of like to remind our clients of, you're getting that offshore exposure, but there is also that kind of currency diversification element, which is one of the considerations. So if you think your entire life by and large is tied to the rand and the rand-based economy, because your employment might be your business might be denominated in rands. Your houses are denominated in rands. All your assets, et cetera, et cetera. So even though you might have some, offshore exposure within your broader portfolio, you are very, very concentrated still to, largely, one currency, because even if you're investing offshore in rands, that money has to come back to rands, So, from a prudent and diversification perspective, having a part of your wealth and your portfolio denominated in a foreign currency, like US dollars or what have you, does just bring in more resilience and obviously diversification into your portfolio. And to your point, as more people are, wanting to, travel, they have kids abroad, might want to send their kids to, study abroad. Some have, second properties. Having a portion of your portfolio denominated in another currency, it's sensible. It adds to your diversification, reduces risk ultimately, and those are all the kinds of factors that you want to build into a robust portfolio. And as we know, the opportunity set as well in terms of investing offshore and investing internationally is just so much bigger than what we have available locally. So those are some of the things one has to also consider when it comes to thinking about how to build a portfolio, how much to have local versus offshore, and the kinds of things that we I guess discuss with our clients.
I mean, we've seen a lot of these sort of investor slides where they talk about, over time, the rand depreciating by, and they throw numbers around like 6%. Now, I guess it's depending on what time period and time frame you look at, but the direction of travel is still the same. Over time, the rand's weakening. After school, almost 30 years ago, giving our age away, we spent a year in London, but can you remember what the exchange rate was then when we left and when we came back?
No, too.
Yeah, so I remember it was R5.50 to the pound, and the year that we came back, sort of a year later, we were sort of hedging out at around R7.50 to the rand. And I remember my cousin saying to me, Stephen, like it's going to go 10 rand to the pound. So yeah, that's one thing, is obviously like preserving real value of your hard-earned wealth that you've created in South Africa, just as a hedge against the rand. You spoke about risk. It's in some ways it kind of seems counterintuitive. People think, oh, I'm taking money offshore, that should be riskier. But actually, if you look at, the South African market as in terms of a market cap to the global market, it's a fraction of the market cap. And so investing offshore actually spreads our risk, right? And so, investing offshore is part of that conversation or that bucket around diversification. So yeah, completely valid around that. In one of our slide packs, we kind of share some data about the weakening of the rand. I know we look at the MCSI in rand terms over the years, and I remember a portion last year, it showed like the 10-year value was negative. Over 10 years, you kind of lost money in rands. Obviously, last year's great returns.
In dollars.
Yeah, sorry, in dollar terms, sorry. Yeah, so the other way around, my bad. In dollar terms, we were becoming poorer. And I mean, that has changed significantly. But I mean, those are all the types of, the reasons why we would be, investing offshore. When we think about taking money offshore, is it a kind of a take money offshore and hold and forget strategy? In terms of, is that money that's likely to come back to South Africa? Or, what are our views around that?
I mean, often, I guess for a lot of the clients that we deal with, that their offshore money is their kind of set and forget money. That's the money that they hope to never need to use. Will use if they have to. Maybe use for things like travel if they, if they're abroad. But it's often that kind of portion of their balance sheet that is unlikely to ever come back to South Africa. In some cases, it might kind of form a supplementary part of their retirement planning. So as they kind of draw on their local retirement assets and, over time want to supplement that with some of their discretionary capital, they might want to access some of their offshore investments in a more, tax efficient mechanism. But for a lot of our clients, that's, the money that they'll, at least mentally, that they feel like they want to touch last. But certainly, offshore and some of our, younger clients that we're dealing with are making, proper offshore investing a bigger part of their kind of retirement planning, because they don't feel, you don't have the Regulation 28 constraints. So somebody with a 30-year time horizon being all invested in equities makes a lot of sense. Over that time period where they may be or end up, or, at some point maybe even potentially, want to move abroad, it sets them up in advance of that, having money offshore already. And then just in terms of that investment capability, ability to access more, interesting investments, and then potentially, like we, discussed, that long-term trend of rand depreciation, could really be a boon to somebody who's kind of investing for the long term. So I guess, there are a lot of very good different and valid reasons for doing that, and it, like you said, the currency, the currency is up and down, it goes through, significant periods of weakness. Lately it's been stronger, but the general trend is over time, as we know, has been weaker. But that really should never be, the overriding motivation. So, whether you're moving money offshore at the rand, now at, 16 to 1, or, at some point when it's 18 to 1 again, in the bigger scheme of things, does it really make a massive difference? To us, not really, because you've got to think about it kind of differently. How are you measuring your wealth and defining your wealth? Should it be in rand? Should it be in dollars? So, the currency decision for us should be the, I guess, the least important.
Not necessarily, trying to punt a particular asset class, but US equities have been quite topical, driven by a few handful of companies which have, over the last few years, have kind of rewritten the sort of investment books. We've had great returns, and I think a lot of youngsters kind of see these companies and the story behind it. Apple, they use Apple phones, so they want to kind of support the brands that they're using, and it becomes a lot more tangible to some of the youngsters these days. And then, I guess just the ability to also have money that is outside of South Africa. Again, we never try sell fear at all. We try have a robust plan. But I mean, some of our clients do want to have that sort of safety net, that's money completely out of South Africa, just in case. I mean, we don't have a view on that, but I mean, those are quite topical kind of conversations that we have around taking money offshore, looking at where the rand is. I mean, again, this is not a scientific study, but I have checked at certain times when the rand was very weak. It often coincided with a weak US market at the same time. And so while some of those investors, took money out at an expensive dollar, they managed to buy more shares or more units at the time. Now, again, not a study that you should be holding me to, just anecdotal. But I remember in the sort of Zuma years, I think I'm going to stand on a correction. Had a client took money off, wanted to take it at, I think it might have been 12.30 at the time, and then a week later there's some bad news came out and it was 12 rand 60, and it was a big stress around that. Today that doesn't really matter, and then, from those days we've had fantastic returns in the US market. And so it becomes insignificant, to your point.
No, exactly. I mean, something also interestingly that's come up for us is when clients are moving money offshore and thinking, okay, well, what currencies do I utilize? Should I kind of spread my currencies around, is it dollars, sterling, euro, all the major currencies, how to think about that. And I mean, that's quite interesting, because you have all the, I guess the common consensus now is that, the dollar's going to weaken because of their massive, fiscal deficits, their high debt levels, so that whole currency debasement like trade, so should you be, holding, foreign assets denominated in dollars, or should you be looking at other currencies? And we made the point to a client recently who'd actually specifically for that reason had some of her money in dollars, some of her money in sterling, some of her money in euros, and said, in theory it's a nice idea, but structurally all the major economies, whether it's, America and the US dollar, or Europe and the euro, or, the UK with the sterling, they're all essentially facing the same structural headwinds, high debt levels, running massive deficits, so, from a currency debasement argument, they all largely fall in the same boat, so, if that's your primary concern, mixing between those currencies isn't necessarily the solution. And what we have said, because most of the major underlying investment opportunities around the world are denominated in dollars. So if you're planning for investing for the long term, then it still makes sense to use, dollar-denominated opportunities, because unless you're investing in Europe directly or in the UK directly, where then it makes sense to use euro or pounds, you're achieving, very little then by having, euros and sterling separately, because if you invest in those currencies where most of the underlying instruments are denominated in dollars, you're just paying hedging costs, and that kind of defeats the purpose. And I guess that then brings in the argument for adding things like, gold into a portfolio, or, for some people, Bitcoin, or, that whole currency debasement trade. But I just thought that's an interesting thing to bring up, because, people here, they must diversify. It makes sense to have different, currencies potentially, but actually, when you look through and understand or what you're actually trying to achieve, well, one needs to kind of examine that a bit more closely.
Yeah, and I mean, in some of those cases as well, those clients are just sitting in cash. And, been sitting in cash for the last few years, not as a strategy, but on the sidelines, and, have missed out anyway. So it kind of just debunks that sort of long-term sort of view on investing anyway.
Exactly. Okay, Stephen. So when we talk about investing offshore, I mean, let's unpack, some of the different options, because you can invest offshore in rands, and what does that mean, and what are the implications of that? Or you can invest offshore, what we call properly offshore. We're investing offshore in, hard currency, whether it be, dollars or what have you, using your single discretionary allowance or investment allowance. And then it's, how you invest that money offshore, and then some of the decisions that I guess follow that. So, how do you suggest one thinks about that when it comes to making that, offshore investing decision, and the implications of all those underlying choices.
Well, I think it's important to actually maybe like just take a moment and define some of those things, what they mean. Offshore investing has become become a lot easier. It's more in vogue. You can go into a banking app and you can buy something offshore. And I think we'll go into it a bit later, but what we're finding is actually the structuring is the crux of it. And we'll go into that. But I mean, how do you invest offshore? You can, invest into local feeder funds. So they're South African denominated funds that have offshore exposure. But there your money stays in South Africa and it's reported in rands. You could take money offshore via asset swap. So you invest in rands. A company has an asset swap capacity, then invests that offshore. But again, your money's still in South Africa. And when you want to cash it in, it still comes back into rands, and there's some sort of potential tax implications there. Or you take money offshore using your foreign allowances. We have a single discretionary allowance. You alluded to that earlier on. Move from 1 million rand per individual to 2 million rand. That you don't need any permission. Obviously, it goes through an authorized dealer, and it's kind of reported to the Reserve Bank, and goes against your record, but that you don't need permission. One of the things that we do find out around that type of offshore investing is there's certain payments that we make to the likes of like Airbnb that actually get debited off your bank account as a foreign transaction. And that actually accounts against your foreign allowance. So, if you have transactions like that, Airbnb, Spotify, I think Spotify now has a local transaction, but there are a few of those type of providers you'll see on your bank. If it's a foreign transaction, they actually count against that direct allowance. And if you then proceed to take 2 million and put it in investment, you're actually in breach of the Reserve Bank rules. But yeah, that's one way to do that is 2 million, or you can apply for 10 million rand. You got to apply at SARS. I mean, it's a bit of a process in terms of the information that they require, but they give you that tax clearance certificate or a PIN to be able to then invest that money offshore. You take that using an authorized dealer, invest it offshore somewhere, or you can actually make a special application to the Reserve Bank to take more money offshore. I mean, you can understand that there's a lot more scrutiny around that, but that's possible. And then more recently, and this is quite the exciting part, is up until recently, South African trusts couldn't take money offshore. Now South African local trusts can fund offshore trusts, and thereby getting money offshore in a trust structure. So previously, what happened is a lot of South Africans would, in their local trust, would have to make distributions to the beneficiaries. Those beneficiaries would then use their foreign allowances and take money offshore, thereby getting that sort of direct offshore exposure. But now a new exciting opportunity exists.
Exactly. And when you do that, it means the local trust, the offshore trust distribution, you don't have the issues around, loan accounts and all of that. So yes, the local trust has to pay tax first. If you're selling an asset, you have to pay tax on that asset. And then you move the cash from the local trust to the offshore trust. But that's a very clean mechanism to fund the offshore trust without worrying about, donations, tax and loan accounts and stuff, because it's a trust to trust distribution effectively. So absolutely, that is a very new, interesting, exciting opportunity.
Yeah, I mean, recently having a discussion with the clients, how is that possible? How would the officials allow that? And you can think about it. It's quite obvious, because if you have money in a South African trust, other than cash, you're likely to make a disposal, and that disposal creates a capital gain. So SARS are getting money via that. But yeah, certainly that's a really nice avenue. So those are kind of the ways to do it. We also see I think post COVID, we've seen this a lot. Property prices in certain areas, and the islands around Greece or in Portugal seemed quite attractive to buy property, and South Africans just buying property using their foreign allowance. Going onto your banking app, it's easy to buy some shares or ETFs. That's not the problem that we're seeing. It's great getting that exposure, but I guess it's the nuance of holding that individual asset in your personal capacity that could be quite problematic from an estate duty point of view and from a taxation point of view. You want to sort of give some information around that?
Yeah, exactly that. So it's never been easy to open a brokerage app, whether it's Interactive Brokers or Easy Equities or all the various derivatives of that, and start buying ETFs or shares, and start to build your portfolio. But then exactly that. What people don't think about are the potential consequences you're creating in doing that. Both from a taxation perspective, and obviously an estate planning perspective if anything happens to you. So obviously holding assets directly in your own name, whether it's in an investment fund or via a brokerage account, means you're getting taxed at your own rates effectively. So at CGT, your highest effective rate, capital gains tax you're paying is up to 18%. If you're generating income in your portfolio, obviously your marginal tax rate's up to a maximum of 45%. So potentially, tax inefficient. But I think more importantly, and what's coming up a lot, is that issue now people are buying ETFs listed on US exchanges like on the NASDAQ or what have you. Or they're buying shares directly in companies, all the big names, Apple, Microsoft, Amazon, Tesla, Nvidia, et cetera, et cetera. And a lot of people aren't aware of the fact that if you hold more as a non-US resident, if you hold more than $60,000 of assets that are regarded as US CITES assets, in other words, for example, a US listed share or a US listed ETF, anything over and above $60,000 is taxed at 40% on death by the US. You're a non-resident alien, they call that. So you build up a nice, offshore portfolio without potentially realizing that on death, your estate's going to be hit with a 40% US estate tax, which also cannot be funded by selling any of those US assets first. You've got to find money from elsewhere in your estate, get that across to the US, pay your taxes before they'll actually...
that's a challenge because, if you don't have other money abroad to fund that, how do you get money offshore? You've got is that a posthumous sort of application for foreign investing? Will the Reserve Bank allow that?
Exactly. So you're opening a whole potential can of worms around, complexity for yourself that you aren't realizing. And then similarly, in the UK, if you own UK CITES assets, there the thresholds are higher. It's above £325,000, where you're potentially liable to UK inheritance taxes of 40% over and above that. But anyway, so the point is, the consequences of making these investment decisions can have real long-term implications without you even realizing. So in other words, how you structure and hold those assets actually becomes super important. So we've got, that concept of, should you use things like wrappers to hold some of your offshore assets? Two of the most, prominent types of wrappers that you can use as a South African investor is the concept of an offshore endowment or sinking fund, that offshore life wrapper. So essentially, what that does is all the assets that you hold inside the wrapper then mitigates things like the US CITES taxes. So you can appoint beneficiaries to the wrapper. So on your death, those assets can pass seamlessly to, that beneficiary. You don't have to worry about US CITES taxes. Also importantly, You then don't have to worry about foreign wills, because if you've got offshore assets in your own name, potentially you need foreign wills. So anything happens to you, probate in that jurisdiction can be dealt with efficiently. So that's another area a lot of people don't have. They've got these offshore assets without foreign wills. So using a wrapper mitigates the need for a will. And ultimately it creates, that seamless succession for, whoever you're leaving the money to. And then also importantly, you're getting a tax arbitrage opportunity, because assets inside this offshore wrapper, like CGT, for example, is taxed at a flat 12%, rather than, the maximum effective rate of 18% potentially if you a higher rate taxpayer. So there's a lot of good, sensible reasons to, when you're putting together an offshore portfolio, to think about, how am I actually going to structure and hold these assets? And then once you've, got a big enough portfolio, once you're talking, $1 million, $2 million plus, then you can also start having a conversation around, well, actually, should we be using an offshore trust for some of the benefits, additional benefits you get there, where it caps the growth in your estate, any future growth in falls outside your estate. And you can kind of do that intergenerational wealth planning and legacy planning a lot more efficiently. So coming back to, the planning conversation, that's why we always say, planning should come before the investment decisions. Because the consequences of not getting that right can have severe long-term, implications and ramifications for not only potentially you, but the people that you one day leave behind without actually realizing.
I mean, you said a lot, and there's a lot of valuable things in. We could probably, do a podcast just on how to invest offshore and the ins and outs of it. But, a few things that I picked up there, and maybe it also follows on a question that we had from a client who said, those type of solutions kind of benefit only on death, and that's not really true. So if you think about, South Africans investing offshore, and from the tax point of view, you have to declare those taxes in your South African tax return on an annual basis. And if it increases your taxable income, you have to pay that taxable income out of rands earned in South Africa. Some of the struggles that we've seen in the past is actually to get tax information. Our tax year typically runs from 1st of March to the end of February. It's trying to get real data out of these offshore providers in terms of what was income, what was capital, and what sort of happened. That's a bit of a nightmare. So from that ease of administration point of view, having it outside of your name sort of ticks a huge box. You spoke about the CGT and the 12% versus 18%, which gives you that 6% arbitrage. But the other important part to note there, that's on hard currency only in those type of wrappers that you spoke about. And in the Income Tax Act, if you hold it in your personal capacity, you pay that on the rand gain as opposed to the cap, the foreign gain in hard currency. So that's also a huge differentiating factor if the rand's weakened over time. In those wrappers, there's no CGT on death if there's a replacement owner on the policy, in the structure. And that's a huge thing. So if you're looking at a direct investment offshore, you potentially paying the CITES taxes, you're paying executors fees, you're paying CGT on that because it's a forced trigger. And also the one thing that we've picked up is the delay. So if you think about an ordinary South African holding investments offshore, they pass away. We have to go through the South African process first of all to appoint an executor or have the executor appointed by the master. That at the moment in Cape Town is taking up to 8 months to a year to get that letter of executorship. And so there's a time period where nobody can make any investment decisions. It's kind of stuck there. We've then got to go through the South African estate process and then take that original will that you've submitted into the South African estate process has to now be ratified offshore as a valid will, and that takes time and it takes a cost. And so, I would kind of venture to say that holding offshore assets over $60,000, you could probably lose about half of that on death. And just by creating a different little structure, you're easing a lot of that, and you making your life a lot easier for you and your beneficiary. So, yeah, I agree with you wholeheartedly. The structuring is the most important thing. And, while it's great that it's become a lot easier to invest offshore, just going on a simple banking app, there's no advice around that, so it's in vogue, it's easy, every single finfluencer on TikTok and Instagram is telling you don't need advice. Why pay an advisor? Just buy ETF, is actually opening themselves up for liability there. One of the other things, Carl Peter, we see quite a lot is around diversification in clients. So, they just, go onto some platform and choose a few ETFs, Could talk about what we're finding there in terms of that overlap and concentration risk.
Yeah, that's a great point. So, clients think that they're creating a diversified portfolio. They've bought an S&P 500 ETF or index. They bought an MSCI World ETF or index. They bought the NASDAQ. And they think, because the S&P 500 has 500 constituents, the NASDAQ, 100 odd, MSCI World, over 1,000, you automatically assume, you've got a diversified portfolio. But what you also need to understand is, what are the companies driving the returns within that particular index? So you've actually got to look, underneath the hood of an ETF or an index type fund and look at the underlying companies that are driving the returns of that. And, what we have seen over the last sort of 5-10 years, as, the big tech companies have become increasingly successful and more powerful, the constituents of those major indices are all, in terms of their biggest holdings, are all largely the same. So within the S&P 500, the top 10 constituents, we all know the names in terms of, the big tech companies. About 40% of the S&P 500 returns are being driven by, those companies. The NASDAQ, significantly higher. MSCI World, slightly less, but, the MSCI World still has, 70% US allocation. So all you're doing by buying these same indexes is creating more of a concentration risk problem than being properly diversified. So what we, say to clients, there's nothing wrong with using index funds and ETFs to build and construct portfolios, but you've really got to kind of, look underneath the hood to see, what companies and industries are driving the returns, of these underlying indices to make sure that you are actually getting, proper diversification. So, it makes no sense just to, lump indices like, the MSCI World and S&P 500 and the NASDAQ together because you're not getting proper diversification. So you want to think about, okay, well, how am I getting exposure to, US markets and technology? How am I getting exposure to, other parts of the world, developed markets like, Europe and Japan, which have, different underlying companies and different return drivers. Then you look at areas like emerging markets, and within emerging markets you can also break that down further. A lot of that now of late has also been driven by AI and technology, like particularly South Korea and Taiwan. So you've got to look at, okay, well, how much overlap am I getting there? What other parts of emerging markets can I look at for diversification? So in terms of that portfolio construction piece, if you want to be properly diversified, it actually does take a lot more than just buying a few index funds and ETFs. And granted, that approach for the last 10 years, if you bought the S&P 500 and the NASDAQ, you've done phenomenally well, absolutely. But at some point, and we don't know when, that tide will turn and things will shift. So if you are really serious about wanting to build a more robust, diversified portfolio, it's not to say you don't want those those allocations to your portfolio. But things like position sizing, looking at other areas, other opportunity sets, other regions and sectors within the world, so that you're creating that balance, which will serve you over the long term, is super important. So that's something I think just worth kind of reminding people of, and everybody, it is quite topical today. So it's I think that's just a good reminder.
Mm. I mean, I think a lot of this conversation ties into, some of our previous podcasts around, why a lot of estate plans fail, the sort of myths versus facts, what to believe, when emotions are running high, try to get rid of emotions. But they kind of all centralize into the same sort of, I suppose, targeted outcome of these decisions should be planning led. And to do that is first to understand what it is that you're trying to achieve, whether it be matching liabilities for family later, whether it be true diversification. It's kind of understanding that. Then structure, such an underrated topic of conversation, because you've got to put a lot of thought behind that rather than just being sold a product. And then, actually looking at the underlying investments. I mean, we're big proponents of, keeping investment costs low, but we're also realistic that we don't just follow the herd approach, that we want to get a balanced view. And so, that's where that sort of soundboarding in terms of our proposition comes in with clients. We take the time to go through all of those things, show implications, and just so that we have an understanding of what each decision will make.
I mean, you make an actually really good point there, because we wrote an article on our blog recently that, beating the market is not a financial plan. Because everybody's now doing comparisons. Are you beating the market? Are you outperforming? Are you underperforming? And is that what you should be measuring your portfolio against? And we take, and it's not to say that you shouldn't be looking at those metrics, but to your point, we start with a planning-led approach. It's first about understanding what kind of return do you need to achieve your long-term goals and objectives. That's the real number that matters. And like we've alluded to in previous podcasts, that's typically an inflation plus metric, inflation plus 4 or 5, et cetera, et cetera. And that then becomes the framework and upon which we kind of make all our investment decisions. Okay. So when we then say, well, are you beating the market? Well, what market? Is it the S&P 500? Is it the MSCI World? Is it the JSE? Is it a combination thereof? Is it, a typical balanced fund type of portfolio, and you can go, into all the weeds of, what you should be measuring against. So for us, our primary concern is understanding that the kind of return a family or a client needs to achieve their long-term objectives, and then measuring that over time, net of all costs and fees, that we call that internal rate of return. And that's the return you're actually getting. So when we're measuring the performance of a client portfolio over time, and you're going to have bad years, so it's not going to happen every year. It's then you've got a clear definition and benchmark against which to measure that. And that's then how we kind of judge the portfolio, and is it doing its job? Do we need to make any changes? Then as a secondary measure, you want to look at, okay, what's a reasonable comparative benchmark here that you want to be looking at, and seeing, okay, well, how's it holding up to that benchmark, and is it a fair comparison, etc. And that, and that kind of only, that's like a very much a secondary decision. And then things like we've been saying now, the structuring and the tax headwinds and, all of that, plays into that as well, in terms of getting that right first, so that you're actually measuring, your objectives and goals, according to, clear after tax, after fees, after cost benchmark. And that is, a much more, we think, a much more robust way of helping clients, achieve what's important to them, and measuring client outcomes, because markets will do what markets do. Markets go up and down, and if you think you're smart enough to beat the markets every year, good luck with that. So, and interestingly, we're also seeing, we think a lot of other advice businesses seem to, position themselves as, trying to beat the markets. And, for us, that's just like you're never going to achieve that consistently over the long term. So if that's, the metric you want to measure yourself against, we potentially think that's kind of fraught with issues. So, yeah, so just something worth bringing to the table.
Yeah, I mean, we haven't seen this in a while, but we've had some new client conversations in the past where investors have burnt their fingers going offshore. And, while you were talking, it just kind of made me think, all those sort of conversations that we have before we get to actually the solution mode is so critical. And, because it means that we understand our clients' needs, our clients understand their needs. We round table it. We sit on the same side of the table as them. We spar and we before we get to a place where we're actually making a decision to invest. If I think back of all those people that have burnt their fingers, they've been shown some shiny brochure, and it's like, yes, this is great. Been driven on fear. The country's going to the dogs. Take your money out now, invest in this, next best thing, which was kind of a fad. And so, again, the conversations is just, let's slow down first. Let's first just understand exactly where we are. And, I think as guardians and and stewards of our clients' wealth, that's the only way to do it, is just to kind of just pause. I think of the rugby, the refs, there was like that hold, pause, engage, and it's that sort of thing. Let's just stop quickly, take a look around, pause. What is it that we need to put in place? Why? Understand the metrics of that before we kind of go into that decision-making process. So, Carl Peter, I mean, before we wrap up, I guess one question we get asked often, this is a debate around, so how much of our wealth should be offshore? What percentage? I mean, that's kind of a question we get asked all the time, but it's not really something one can answer.
Yeah, I mean, exactly that. I mean, it's, how long is a piece of string, and it's different for everybody, what are your lifestyle needs? What's the size of your balance sheet? What are the risks in the way your portfolio is currently kind of structured, and the exposure that you have. So for, one client, or family, it might be, 70%. For another, it might be, 10 or 20%. So there is no, I guess, universal number. And it also, it's also, one has to be realistic about, what's possible and for you as an individual or family. If you're somebody starting out and starting your investment journey and what have you, having, rand-based offshore, feeder funds, is a great place to start. As your, I guess, balance sheet grows and your needs evolve and perhaps your levels of wealth and success increase, well, then it starts to make sense to, thinking about diversifying, properly offshore, in hard currency. So, you get these, like, you read it in the media, you should have X percentage and, what have you. But it is a very personal decision that, is different for every individual and family. How do you think about it? And
I mean, out of all these things, and, our approach to financial planning is not a one-size-fits-all. We don't follow a cookie-cutter approach. We build everything from the bottom up, and that, the heart of that is understanding what's important to that particular client or family. A young professional starting out, has potentially a need to get into the property ladder in South Africa, and so while they might have some excess cash now, if you need to match their liability or their future liability and putting down a deposit for a property in the next year or two is completely different to a family that is established, has enough money to meet their sort of daily needs in South Africa, monthly, yearly, whatever it is. And and has wealth, what we might refer to as excess, or just money that they not necessarily going to need. The answers to those differ based on those circumstances. So, while we do think offshore investing is great from a planning point of view, I think we've been quite clear today as to say that it's not an emotional decision. It should never be driven by the emotions. It should be planning led. The type of conversations we're going to have is really understanding the structure and kind of where it fits in. And that, because we're an outcomes-based business, whether it's you need income from it, whether it is just that like backup plan B money, or it's long future generational wealth creation type of conversations, those will lead the direction that you need to travel. So it's really from a bottom-up approach. And yeah, I think any person who goes out to tell you need to have X amount percentage, is probably a quack.
And on that note, yeah.